Welcome back, everyone, to the Deep Dive. It's just me today, but we are tackling the absolute titan of the market. A company that is practically carrying the entire AI revolution on its back. NVIDIA. Ticker NVDA. They just dropped their Q4 and full year fiscal 2025 earnings. And honestly, the numbers are staggering. We're talking about growth so massive it almost doesn't feel real. But, and there is always a but with NVIDIA these days, the market reaction is complicated. That brings us to the central paradox of this quarter. They just delivered the highest revenue in company history and beat Wall Street's expectations. Yet, people are obsessing over compressed margins and supply constraints. It's the curse of perfection. When you're priced for absolute perfection, even a tiny blemish becomes the headline. So, let's cut through the noise using our 5-part framework: the scorecard, the profitability engine, the financial fortress, and the Blackwell Supercycle that is reshaping the company. The at-a-glance scorecard. Let's look at the headline numbers. For the fourth quarter, revenue hit a record $39.3 billion. That is up 78% year over year. And just for context, Wall Street was looking for something around $37.5 billion. So this is a solid beat. For the full fiscal year, revenue was $130.5 billion, up 114%. They more than doubled the size of the company in 1 year. But we have to talk about where that money is coming from. It's not video games anymore. Data center revenue was $35.6 billion in Q4 alone. That segment is up 93% year over year. It is practically the entire business now. Here's the nuance you need to catch. Look at gaming. Gaming revenue was $2.5 billion, actually down 11% year over year. Sequentially, it dropped 22%. Why? They blamed supply constraints. They are prioritizing manufacturing for the big AI chips over gaming cards. It tells you exactly where their priorities are. The engine of profitability. This is where the controversy is. The margins. GAAP gross margin came in at 73.0%. Now, 73% is incredible for hardware, but it is down from 76.0% a year ago. And sequentially, it dropped 1.6 points from Q3. This is what the bears are latching on to. So why is it happening? Is pricing power slipping? No, not at all. It's the transition cost. They are switching from the Hopper architecture to the new Blackwell chips. The CFO commentary explicitly mentioned inventory provisions for low-yielding Blackwell material. Blackwell is complex. Early yields are lower, so they have to write off some bad chips, and that hits the margin. It's the cost of innovation, not a demand problem. And even with that hit, their operating income was $24.0 billion, up 77% year over year. They are still printing money. Financial strength and shareholder rewards. Slide 3 is the fortress. Cash, cash equivalents, and marketable securities are sitting at $43.2 billion. And remember, they generated $16.6 billion in operating cash flow just in Q4. They have more cash than they know what to do with. Well, they definitely know one thing to do with it: buybacks. Aggressive buybacks. In fiscal 2025, they utilized $33.7 billion for share repurchases. And they still have over $50 billion authorized for future repurchases. This is a huge signal. It says management believes the stock, even at these highs, is still a good buy. They pay a dividend too, but it's tiny, About $834 million paid out for the full year. It's mostly symbolic, but it checks the box for income funds. The road ahead. This is the Blackwell slide. The CEO, Jensen Huang, called it the fastest product ramp in company's history. The numbers back him up. They delivered $11 billion in Blackwell revenue in Q4. Just boom, right out of the gate. But here's the constraint. They explicitly said demand for Blackwell is expected to exceed supply for several quarters in fiscal 2026. That is the bottleneck. They can't make them fast enough. And what about China? That's been the big risk factor. It's still tricky. Data center revenue in China grew sequentially, but it is still significantly below levels seen prior to the imposition of new export control restrictions. Because they can't sell the top-tier chips there, the domestic competition in China remains fierce. But honestly, the demand in the US and everywhere else is so high, they don't even need China right now to break records. The final narrative. Let's pull it all together. 3 themes for NVIDIA right now. Theme 1. The infrastructure arms race. Everyone is racing to build AI factories. The $11 billion Blackwell ramp proves the cycle isn't over, it's just upgrading. Theme 2. The margin trade-off. Do not panic about the 73% gross margin. It is a temporary dip while they learn to manufacture Blackwell efficiently. Management expects margins to return to the mid-70s when fully ramped. And Theme 3. Physical AI. Jensen explicitly talked about agentic AI and physical AI setting the stage for the next wave. Automotive revenue was up 55% for the year. That is the next leg of growth. Self-driving cars, humanoid robots, industrial automation. So, the final verdict? It's a generational story. They are effectively the utility company for the AI age. As long as big tech keeps spending on CapEx, NVIDIA keeps winning. Thanks for tuning in to the deep dive. And remember, folks, this is for informational purposes only. Do your own diligence. I'll see you next time.